Welcome to Retiring Well. Listen, folks, we've got a great show for you today. There's a number of subjects I'm going to talk about. First of all, when is it that you need a trust? When we're doing estate plan. Active versus passive management of investments. Surviving spouse taxation. How much risk can I take on? And there's only 2 ways to grow a portfolio. All the things we're going to talk about today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome to our show. Listen, in this segment, I want to talk to you about trusts. Now, I am not an estate planning attorney. We'll have these conversations a lot with our clients. We can at least kind of direct traffic. But I want to give you some reasons that you might want to think about a trust. Now, this is all encompassing. There's going to be several reasons, but I just want to give you primarily 4 that I can think of that you might want to be thinking about. First of all, most times people have a trust, and we use this in the past quite heavily when we are trying to avoid what's called estate taxes. Okay? Now, I'm not going to go into a lot of depth with that because today individuals can pass on a whole lot more than they used to be able to without any estate tax. As an example, an individual can pass on $11 million with no estate tax. If they're married, that's $22 million. Now, the only exception to that is IRAs, because IRA money has never been taxed. But that's not going to affect a whole lot of us, is it? Another reason you might want to trust is to avoid probate. A good estate plan is where all your assets know where to go when you die. All right? If they all know where they got to go when you die, then nothing has to go to probate. That's a good estate plan. It used to be that some assets had to be put into a trust to avoid probate. Okay, for example, a house. But today, with the use of Lady Bird deeds, we can set that beneficiary designation on the house so it knows where to go when you die. Doesn't necessarily have to go through a trust. But there may be assets that you need to put into a trust per se for that reason. Another reason you might want to trust is maybe you have a beneficiary that has special needs, and they're not allowed to have certain assets, or it affects their, let's say, their aid. Well, you might be able to put that into a special needs trust whereby it doesn't count in their assets, but it's money that still can be used for their care if they need it. Now, another reason you might want to trust is if you want to make, let's say, distribution elections after you die. Okay, now think about this. If you pass away and you leave somebody a lump sum, they have full access to that lump sum right away for whatever reason. What if it's somebody that doesn't handle money very well, and you're concerned that they would maybe make bad decisions accordingly with it? Well, if you put it into a trust and then dictated how they could use that money, like maybe for just education, health, maybe their living expenses, then a trust would be appropriate for that. Maybe you have a younger beneficiary that couldn't handle a lot of money at the age they're at right now, and maybe you want to put it out there so that they have to wait till a certain age, let's say maybe like 30, and they might be more established. This is how you can make those distribution elections in a trust. So I hope that kind of gives you a feel for some reasons why you might need a trust. So I encourage you, give us a call. There's no cost, no obligation. Just sit down and talk and let us help you see where we might be able to direct traffic in helping you have a good estate plan. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, welcome back. Listen, in this segment, I want to talk to you about what is called passive investing versus what we call active management. 2 different things, folks, and it's something you're going to want to be very, very aware of. First of all, one thing that's out there that's it's growing in popularity is what we call ETFs, or exchange traded funds, okay? Liken these like a bucket of securities, all right? And basically, once you put all those securities in that bucket closes. Okay, there's no longer any trading happening on it. It's basically like an index. You're just basically tracking that bucket of securities. That's what an exchange traded fund is. Now, they trade on the New York Stock Exchange just like a stock does. They're highly liquid because you can buy and sell them right on the exchange. But basically, it's passive because there's no trading anymore going on with that account. That bucket, that ETF is going to hold those securities no matter what until you sell it. Okay, so you might find if there's no changes happening, then that's probably leaning more towards, you know, a passive account. The other thing is when you look at a mutual fund, for example, all mutual funds have objectives, okay? Meaning they have an objective to hold certain securities in that fund, in that account. Okay, now unlike an ETF or an exchange traded fund, there's trading going on within that account, okay, based on that objective in the securities they hold. For example, let's say I'm in what I call a large cap mutual fund. That's simply a mutual fund that has to hold large company stocks. That's what its objective is to do. And so that fund manager is going to buy and sell large company stocks within that portfolio. Now, even though that change is happening, you've got, you know, some management happening with that. It's somewhat passive in the sense that it's only going to hold those securities that it holds. All right. Now, the key factor to understand when you're dealing with ETFs or mutual funds is understanding what they hold and what they're going to do when market conditions change. Because if all you're holding is certain sectors or certain asset classes and you don't have effective diversification, then it's going to be very passive because it's not going to change up a whole lot. Okay. Now, active management. These are going to be fund managers or portfolios that are actually going to change with the market conditions. They might not be held to objectively hold any particular assets within their portfolio. If they see interest rates rising and bond values maybe going down, then guess what? They can change that up. Maybe they can lower their exposure accordingly. All right, but what you want when market conditions get such that, especially as we approach recessionary times, you're going to want to be careful what kind of account you're in because you may find it necessary to maybe be more in accounts that are active that can change up rather than be passive. So if this is a concern for you, something that you want to understand more about, then I encourage you, give us a call because we'll gladly take a look at that for you. So in that first segment, I was talking about when you need a trust, and hopefully it just gave you some better ideas when you need that. You know, estate planning, if you don't need a trust, you can significantly reduce the cost of your estate planning. So very, very important to understand that. Our job at Centennial Wealth when we're doing estate planning is not only making sure that we get the estate planning attorney involved and we have all the proper estate planning docs, but then we want to make sure that the estate plan is fully funded. You know, a lot of times clients will get a trust and then they don't fund the trust. So if they have assets outside of that estate that don't know where to go, now something has to go to probate. It kind of negated the whole purpose of having the estate plan in the first place. So not only is it important to have the estate plan done, but then you want to fund it appropriately. And then the reason I talked about active versus passive management is, listen, passive management works great as long as markets are cooperating. If I'm in an S&P 500 index and the S&P 500 for the most part its trajectory is upward, well, I'm going to do very well with no active management, right? I'm passively holding that and it's going to go up. But the opposite is true as well. When the markets are correcting or going down, that account is going to go down. So I dare say when markets are cooperating, passive strategies are perfectly fine. But when markets are not cooperating or very volatile, maybe active management might be more appropriate for you. So anyway, knowing the difference between those can be very, very helpful in your investment strategy. So I want you to stay tuned. When we come back, I'm going to talk about the surviving spouse taxation, how that might just something you might want to look at as you're doing your tax planning, and then how much risk can I take on? So stay tuned. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at sen-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Hi, welcome to Truck Talk. Listen, what I want to talk to you about in this segment is surviving spouse taxation and why it's so important to understand. So here's a couple. They're getting $45,000 in Social Security. Now just don't know this, one's getting 30, the other's getting 15. Now they want $81,000 of income. So they're just going to take $36,000 out of their IRA to make up the difference. Now Uncle Sam says in this particular case, $18,000 of that Social Security is going to be taxable income. Now they get a standard deduction for $26,000. Okay, their taxable income is $28,000. Income tax, $2,992. All right, now one of them passes away. Now, if you didn't know this with Social Security, the surviving spouse gets to keep the higher of the two Social Securities. So he or she gets to keep 30, but they lose 15 in Social Security. Now, he or she still wants the same income of $81,000. So now all they're going to do is take an additional $15,000 out of the IRAs to make up the difference. Now, Uncle Sam says in this particular situation now, okay, look at this, $30,000 in Social Security, but now $26,000 of it is taxable income. Look at the difference. Over here, $45,000 in Social Security, only $18,000 of it was taxable income. All right, so they get a standard deduction that's half the amount they had before because they're single now. Okay, taxable income, $63,000. Income tax, $9,890. Now folks, understanding this is very important. Why? Look at the difference here. A difference of almost $7,000, and all he or she did is take an additional $15,000 out of the IRAs to make up for the lost income they lost from Social Security. How can this be? So understanding what that taxation is going to be to the surviving spouse is just as important as it is when you're both together in your married years living. Maybe we could have employed some IRA exit strategies like being more aggressive with the Roth conversions. So by the time that person died and there was a surviving spouse, none of the Social Security ended up being taxable. Maybe we could get them into a situation where they had zero tax at all. Again, no cost, no obligation to come in and let us see if you're a Roth conversion candidate, maybe show you what your situation looks like. Give us a call.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time, we'll have reports that show us the percentage of assets currently in high-risk vehicles, as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Hi, welcome back. Now listen, in this segment, I want to talk to you about risk. Most importantly, how much risk can you take on? Now I just want to emphasize can, C-A-N. C stands for your capacity to take risk on. Okay, now this is where most of us advisors go initially. All right, we want to have some test by which we can determine how much risk we believe you can take on. Some like to use the rule of 100. You know, where they take 100 minus your age, and that shows how much risk you should be on. Okay, so if I'm 65 years old, maybe I at that point should only have 35% of my portfolio at risk. Okay, we might look at your net worth. The idea that the more you have, the more you can lose. Okay, there's all these things that we look at in determining your capacity to take on risk. But what is also important is, again, going back to that CAN, is A, your attitude towards risk. This would be your personal feelings. Now, you know, this is vitally important because I, as an advisor, might determine your risk to be one thing, but your personal feelings might be completely different. You know, what if I am that person that says the more you have, the more you can lose, and I determine you should be able to have much at risk, but you're somebody that's saved for quite some time and you don't want to risk or lose anything. Well, wouldn't I need to know that? So your attitude about risk is very, very important. Now, another place we might go, going back again to that CAN, is N, your need to take on risk. All right, now this kind of comes together when we do income planning. Okay, we're trying to take your assets, how much you want for income. We look for guaranteed sources of income, like maybe Social Security or pension, and then we determine by how much you're going to have to pull out from that portfolio to make up that difference. Okay, well, when we have to put that together in an income plan, what we're really doing is trying to see, will your assets outlive you? Because the last thing you want to do is run out of money before you pass away, right? And it would be nice if you could leave some behind. Now, what if we do that income planning and your need to take on risk is, let's say we have a growth rate of maybe only 3%, and we find that that portfolio or that money is going to outlive you. Well, then we need to ask the next question. If all we need is 3% growth, why are we taking on more risk than we need to? Very, very important. Now, all these factors are going to be important in determining risk, but I would dare say your personal feelings would have to be the most important. So if you're somebody that wants to make sure you're set up appropriately, that your risk and how you feel about it is set up appropriately with your investments, then I encourage you to give us a call.
Folks, I hope you found those helpful. The reason I had talked about surviving spouse taxation is, you know, a lot of people in their tax planning look at it when they're married, maybe filing joint, and no planning is done as far as trying to see what's going to happen later when he or she passes away. You know, understanding that is very important because, you know, maybe there's some things I could be doing in my planning today to properly prepare for that event when it comes. And as you could see, the taxes can be significantly higher when you get into that stage when you're single, not married any longer. So I hope you found that very valuable. As far as how much risk can you take on, I can't say it strong enough that your personal feelings are got to be most important. Again, me as an advisor, I can sit there and determine what I think is appropriate for you. But at the end of the day, I better know what your feelings are. We saw too many people come out of 2008 when we had that, market crash. People thought they were conservative. They heard words like balance strategy. They thought, okay, that must mean I can't lose a whole lot. Lost 30-40% and had no clue they were taking that kind of risk on. So that conversation, before you even develop some kind of an investment strategy, has to be primary. If you're somebody that doesn't want to lose more than 5-10%, and you have a portfolio that historically has maybe lost 30-40%, based on the way it's invested today, you're most likely going to want to make some changes or adjustments. At Centennial Wealth, remember, we have the tools to be able to get behind any portfolio as it stands today and actually see how it did the last 10, 15, 20 years. Most importantly, how it handled through the last two recessions, 2000 through 2002 and 2008. If as you're sitting today, that portfolio lost 30-40% in those periods of time, that was what they call the drawdown, then you're probably going to want to make some adjustments accordingly, especially if you think volatility or those kind of market crashes might return. So very important to understand that. Just remember, if you're somebody that's out there that's sitting on a portfolio like that and you would like that analysis done, give us a call. Remember, it's free. There's no obligation. We'd love to share with you, one, how you're positioned, and two, how maybe we're handling things with the market realities we find ourselves in today. So if that's you, by all means, give us a call.
We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, my name is Larry Flynn. I'm a financial advisor, senior partner here at Centennial Wealth Advisory. Listen, with this coronavirus, it created unprecedented times. High unemployment, you got a lot of businesses not reopening. Whether there comes a treatment or a vaccine for this disease, we don't know. There's just a lot of questions, a lot of uncertainty. But your financial well-being is still very important. And if you're in retirement or near retirement, then getting some good, sound financial advice is going to be critical. So in these unprecedented times, we're understanding that safety is a concern, and so we're offering a couple options. If you're willing to talk by phone or want to do a virtual meeting, whether that be Zoom or something like that, we're offering that ability to do that. If you're somebody that does want to meet in person, we're trying to accommodate that as well. We're saying, we're not going to have any two clients meet at once. We're sanitizing it before and after you're here, and we're keeping the proper social distancing in place while we meet. So if these are a couple options you might want to pursue, we encourage you to just give us a call on the number that's on the screen or visit our website at sun-wealth.com and just basically you can set up a meeting there. Stay safe. If you have some financial concerns and need to address those, then certainly give us a call. Hi, welcome back. Listen, I want to talk to you about the two ways that you can grow a portfolio. Now, one way to grow a portfolio is through what they call yield. Yield in a portfolio is actual interest and dividends being earned on the underlying securities. If I'm a stock, I'm paying a dividend. That's yield. If I'm a bond, I'm paying interest. That's yield. Yield is the actual income. Liken it to a rental house where you're receiving rent income. Okay? Now the second way to grow a portfolio is through appreciation. Okay, that's the idea that you're going to be able to buy a security at one price and hopefully is going to grow to be at another price, and you're going to be able to lock in that gain and sell it off for that gain. Okay, that's the second way you grow. Liken that back again to the rental house, where you have a house and it's growing in appreciation. Now, what's important to understand is between yield and appreciation is that usually more volatility is associated with the speculative piece. So as you look at your portfolio, very important to understand how much yield you're getting, because the lower the yield, the more you're relying on speculation, the more volatility you're most likely going to have. We have the tools to be able to dive into your portfolio and tell you exactly what your yield is. So I encourage you, give us a call. No cost, no obligation to look at that for you.
Well, I hope you found that valuable. You know, understanding yield in a portfolio is again, very important. That's the actual income coming from that portfolio. If you want to have less volatility in a portfolio, the higher the yield, the better. You know, if you've got two portfolios, you know, that are averaging, let's say 6-7%, and one's got 4% yield and the other one's only got 2%, which one do you think is going to be more volatile? Stands to reason, the one with less yield. Folks, in the last break, I was talking to you about this analysis that we can do regarding risk, right? Looking back and seeing how you're positioned today, how much risk what was the drawdown in the last two recessions, right? And how important that is to know. Well, the other thing we can actually do in that same analysis is look at yield. You know, based on all the underlying securities that you have, the stocks and bonds, how much is it actually earning? All right. Now, in this low yield environment, folks are very unpleasantly surprised a lot of times to find out that yield isn't exactly what they thought it was. So maybe that's maybe that's you that wants to know that. Then encourage you to give us a call. Listen, in all these segments we've talked about today, we've talked about a number of things. You can see why planning is so important. You've got estate planning, you've got tax planning, which is very important. Your investment management, obviously very important. Income planning, if you're somebody near retirement or in retirement, you want to make sure you have an income plan so your assets outlive you, right? Unless you know when you're going to die, and you can write that last check to bounce to the funeral home, right? Most of us don't know that. So, but all that planning is not only important; it all has to work together. What might be good in my tax plan might not be good in my income plan, or might be, not might work for my estate planning. So having all of those work together, vitally important. If you're somebody out there that's not getting that planning, you're not having those conversations, then I encourage you, give us a call. We're always welcome to visit with you. First time, no obligation. We'll show you what we do, how we do it, and if that's a good fit for you, great. If not, no harm. It was a privilege to at least get together with you and show you what we do. So I want to thank you for joining us today. I'll be back next week. See you then.